it comes. I mean, I'm paraphrasing the title of the recent paper in the AER, coming from some macroeconomists who say taxing capital income not a bad idea after all. And it's very funny because you did expect those people to be in favor of capital income taxation, and they discover suddenly that it's a good idea. Like if you would discover suddenly that taking a shower or brushing your teeth every morning would be a good idea. The issue of capital income taxation it's a tough one. Steve just showed a viewpoint, which is a viewpoint of the Merlis review. Talking about Merlis, let me start by an anecdote. My talk is very short, so I can start with an anecdote which shows, that the topic is complicated. Jim was in Munich and introducing the Merlis review. What he thought was the Merlis review at that time, because the Merlis review has changed over time, and Steve gave me an account of the Merlis review, which is different from my earlier perception. But that's a real review. You gave us, Steve. I'm sure it's. Anyway, Jim was talking about the pros and the cons of capital income tax, like a good economist, he was saying on the one hand, on the other hand, but clearly, he was stopped by a tough chairman, like the one we have to this afternoon. He was stopped by the chairman. One, I think, is on the one hand, or the other hand was the wrong one. Anyway, at the end of his talk, I told him, Jim, it's very strange. I always thought that you were a liberal and that you were in favor of taxing capital income after all. And you gave us the feeling, particularly with your last point, that you were against taxing capital income. And he said, are you sure? And fortunately, there were two guys behind me, two Germans, who were still in the classroom. And they said, yes. Oh, he said, I'm really sorry. So you see, it's a very complex problem. I'm not supposed to comment what Steve said, but I cannot resist saying two things, which is a way of introducing my own way of looking at the problem. I think that you hardly talk seriously about redistribution in your, when you talk about redistribution, which really means, taking money from the rich and giving to the poor, it was not very well, you didn't seem to be very convinced, if I can say. The second thing is that you are overemphasizing the question of distortion across time. You always talk about not distorting the choice between the present and the future. But we know that there are many other distortions. There are distortions in our choice of commodities, the choice between consumption and leisure, and that's going to be one of the points of my talk, my short talk, because Roger told me that he didn't want to have any model. So let me give you a little bit of history, which is my view. I've been in public finance for the last, 40 years, no, 30, sometime. And this is the way I see it. Can you see? It's not, So I started with someone, maybe some of you know, it's a Musgrave textbook. My teacher was Joe Stiglitz at that time. And at that time, we started with the comprehensive income tax, the ability to pay principal. And we thought it was natural to do that. You look at how much people make, regardless of the sources, and you take away the money from the rich and you give it to the poor, and you take also part of it to finance public goods like national defense or highways. And we thought that it was pretty natural to do that. Then came some articles or some new findings, like, the one is Collège and Hague. And what these people show is that we should be careful because we have different sources of income. Income can come from saving, can come from labor. We can devote or allocate income among different types of goods. And if we want really to do a good job, we should first realize that we cannot tax some goods, and particularly leisure. We cannot see exactly how much people can afford to produce, because there is some hidden information, and because of that, you get the idea that we should have a differential taxation of goods, of commodities, and particularly of labor and capital, which does not mean that we should not tax capital, but the taxation of capital could be different from one on labor. And basically, if you follow Corlett and Haig, the idea that you should try to tax not really capital, but it was consumption, current consumption, future consumption, and you should tax the consumption which is the more complementary with leisure. And I don't know if Roger mentioned that in his class, but so that was the basic idea. But that's the theory. But then came the reality. I come from Belgium, and we were the first to introduce the so-called dual system or the Nordic system. When I came back from the States to live in Belgium, I was surprised to see that no one was paying any tax on capital income. They were not declaring it, or they were putting their investment in Luxembourg or in the Netherlands. And so we were playing the game of the Heck-Simon principle, but in fact no one, except a few good citizens, no one was paying the tax on capital income. So the government decided to introduce what they called at that time, I'm going to use the French word, l'impôt libératoire. And basically, it's a withholding tax. You pay 15%. It went on to 25%. It's very interesting. The government groped to try to get the best tax rate to get the maximum revenue. Now it's 15% at least on most capital income. And so, so you pay a progressive tax on earnings of labor income, but on capital income, you pay, that fixed withholding tax. So it's not theory, just to be pragmatic. The same way as in some countries you don't want to legalize the use of grass, marijuana, but you have to do it because, you realize that 1/3 of your population is doing that. It was the same for abortion. You can have some principles, but you have to adjust to the reality of the world. Anyway, let's go back to economics. Then we move to some stories. Theory, came, and so you have the paper by Atkinson and Stiglitz, which can be interpreted in one way, in a very particular way. I will come back on that, as leading to no tax on capital income. And then you had Chamley and Judd, who did the same with a dynamic type of model. And all of these guys, but one, and I would not say which one, are very sorry that their initial papers were viewed as a plea in favor of zero taxation on capital income, but it was too late. So you move now to a bunch of, I don't remember which year, it was 75, 70, maybe 80. We have a bunch of reports. We have the Mead report, and then we have the blueprint by Bradford in the US, which was in favor of moving away from the comprehensive income tax, that's what Steve showed us, and to move towards the expenditure tax. I'm following Kaldor, famous book. We had an expenditure tax. It was a progressive, it's always important to say it's a progressive expenditure tax with, at the end, some sort of tax on wealth transfers. And then 30 years later, history goes fast, we have the Merle's review, which gives about, Steve just showed about the same message with his Trans-European Express formula for taxation, TEE or EET. I'm not going to come back to that. And then now you have a bunch of macroeconomists, the macroeconomists in the line of Chamley and Judd and some other people, and they come with the fact that they realize that after all it's not a bad idea to have a tax on capital income. And then you have the book pour une révolution fiscale, isn't the title of your book? Yeah, which ends up with recommending to come back to the comprehensive income tax, if I understand. But you will, a little bit, I guess. I mean, that's my interpretation. So you see that life is a cycle. But I don't want to comment, you will come back on that. That was a history. I mean, you can see that over a period of 35 years, I mean, things have changed quite a lot, even though we come back to some basic ideas. The facts, just want to come back on basic facts. First, I see in many countries, I don't want to talk about all countries, but most countries I know, and it was shown by the gentleman from the OECD this morning, increasing with a lot of income inequality, wealth concentration. I think Thomas has shown that for several countries, increasing role of inheritance. I mean, that's very basic, I mean, those facts. And these are not marginal changes, they are basic changes. But at the same time, we see a decline of wealth transfer tax and a decline, a disappearance, in fact, with the exception of France and a few, I was going to say African or Asian countries, but I mean, an annual wealth tax does not exist anywhere anymore. Then other facts, I mean, we are always talking about the capital being very heavily taxed, or the labor, depending on which faction we belong to. We don't know. I've been asking several people in public finance, what do you think is the most heavily taxed? Is it capital or is it labor? It's a very tough issue, and I don't think there is a straightforward answer, but we have to keep that in mind. Also, another fact, as I said, about the case of Belgium or the dual taxation system is the fact that the threat is not just distortion or standard inefficiency, but the fact that the mobility of the tax base, as I explained to you about Belgium, I mean, you can have the best theory you want. If the tax base is escaping like a piece of soap, I mean, there is no way. I mean, you can do anything. So, well, there are some ways. I mean, international agreements or maybe better exchange of information. But we cannot avoid looking at the facts, and I mean, they are stronger than ideas sometimes. Yeah. The outline presentation, the introduction that's made, and I'm going to just cover quickly a few ideas. I mean, the theory, but I don't even know that. Well, I will. In the economics of taxation, I mean, a nice way to proceed is first to assume that we have a single individual. It makes life easier. And then we have basically three contenders, but I mentioned that earlier, for the taxation. And what we do, we have precisely the Collet-Hague principle, as I said earlier. We should tax the good or the consumption, which is more complementary with leisure. And again, here, I mean, we can have, with a particular case, we can show that capital income could escape taxation. But we have to make strong assumptions about separability. So we always need, to get the idea that capital income should not be taxed, and that's going to be what I'm going to show, throughout several models. We always have to make very, very extreme assumptions. I'm not saying that we can prove that capital has to be taxed at the same level as earnings, like if it's the case in the comprehensive income tax. But we cannot really show, there is no good theory which shows that we should not tax capital income. And if we have a model in which we have dynamic inefficiency, or we have some problems with growth, it's clear that we have to look at the amount of saving. Do we need more saving, less saving? In general, we need more saving, but it's not because we need more saving that we have to not to tax capital. In fact, there are basic models where you have to tax, capital and subsidize labor to get more savings. So the issues are very complex. An interesting thing is when you get a model which is a bit more realistic, instead of having just a model in which you live for 2 periods, you work the first period and consume, and the second period you don't work at all, and you just consume, you are retired. If you start to have a model where you live several periods, you work in each of these periods. For example, in the case of 2 periods, you consume C1 the first, C2 the second, you work L1 and L2 in the first and the second. In that case, you can show that the optimal tax could very well not include a capital income tax, but in that case, you should tax people differently according to age. So you should have a tax which is different according to age. But if you don't want to do that because politically it's not feasible, then we come back to the capital income tax. Then we have the Chamlet-Judd, which is a particular case which shows that in the steady state we don't have to tax capital income. And the basic story is that there are many assumptions behind the Chamlet-Judd result, which I'm not. You get them on the screen. I guess I'm not going to spend too much time on these limits and on these extensions. So when we move to the heterogeneous individuals, when we really deal with the redistribution across individuals with different productivities and endowment, again, we have a particular example which shows that if we have weak separability, we can avoid taxing capital income. But this is, again, very particular. And we can show that in an OLG model with growth, I mean, this is not going to apply. You need separability. You need precisely optimal income taxation. If you don't have optimal income taxation, it's a bit different. And as soon, Steve was nice to mention that, as soon as we have other characteristics like the fact that rich people tend to live longer, to be in better health, they can have a higher inherited wealth. I mean, when you have more than one characteristic, you can show quickly that taxing capital income, it's a way of catching something that you don't observe. And so it's desirable to have some type of capital income tax. My basic idea, I mean, it's a bit, it's that finally it's not so much theory. When I look at the debate on capital income taxation, and more generally, I mean, on anything dealing with wealth and wealth taxation and wealth income taxation, I realized that maybe the economic arguments are not terribly important. Everything is terribly political. And we, in the tradition of Musgrave and Kitson and Stiglitz, we always start by saying, and Steve started that way by saying we want a system, a tax system, we want to look at it in the full generality, and we would like it to be as, to respect the principles of equity and efficiency. The problem is that in the real life, we have political considerations which are quite often orthogonal to what I would call the economic rationality. I will mention that. I will come to that I'm coming to that when you talk about all the discussion about wealth transfer taxation. It's totally crazy. I mean, what's going on now? But I will move to that. Let me say just, but Steve mentioned that at least in the debate I know. On capital income taxation quite often, but Steve didn't do that, but most people do that. We forget about tax on capital gains, accrued or realized. It's often neglected. How can we catch that? In most countries, we don't tax those capital gains. We don't tax them very well. And one of the defense, in fact, for the annual wealth tax and for the estate tax or inheritance tax is precisely to try to get, at the end of the life of an individual, some of these accrued or realized capital gains. I would like to say a few words about the the wealth transfer tax, even though I think Thomas will mention that also, I don't know. The wealth tax the wealth transfer tax is a funny tax because I have read several books by economists, but also by philosophers. I mean, everyone acknowledges up to I would say 20 years ago that it's the best tax, and at least at the same time, it's the most disparaged tax you can imagine. I mean, it's called the death tax, the tax I think in England it's called the tax for the stupid, implying that if you are smart, you will not pay the tax because there are so many ways of avoiding the tax, so only the stupid are paying the tax, which means that we should not cancel the tax, we should not, we should keep it, we should even increase it, because, I mean, why not? I mean, a good tax on the stupid is not a bad idea. I mean, if you believe in the Darwinian idea of life. It's on the way down everywhere. I mean, you can see that. Well, the funny thing is that I've been looking at the tax revenue of the inheritance tax. It's independent of coverage. For example, in the US, we have about 1% of people who pay the tax. And it's going to be even less because the ceiling, though, the starting point at which you pay the tax in the US, starting the 1st of January, it's for a couple, and the couple matters in those matters, it's $10 million. It's not bad, I mean, 10 million. So it's you don't have many people. In Belgium, it's 50% of people who pay the tax, who are concerned by the tax. The funny thing is that you get about the same revenue in the two countries. And when you look, I mean, so this is a sort of law which is you get about 1% of tax, a bit more than 1% of tax revenue, regardless of the type of tax you have. The funny thing with the tax also is that most people, I mean, as you can imagine, in the US, most people, 99% of people will never pay the tax, but they are quite often they are in favor of dismantling or at least not increasing the tax. Whereas you have a few wealthy people, but those people are maybe not stupid, they are crazy. I mean, they are in favor of increasing the tax. So, I mean, there are two important features in the tax, and one of them is that it depends what is the motivation for the bequest. I mean, is it accidental? I mean, you didn't plan to leave anything to your kids. You don't have any kid after all, but you kept some money. You died prematurely. You have some money left. In that case, there is a good case for taxing the estate. If it's altruistic, I mean, we know that there is disincentive effects, but that's why some people believe that the ideal is to increase the tax on inheritance and to try to make even easier than now, inter vivos gifts. So the people who really love their kids, they give them money before dying. And that way, I mean, when you die and you still have some money, I mean, the government can take it. It's a bit extreme, but it's a way of looking at the problems. Behind the estate taxation there is a view of the family. For example, in the US, you have the estate tax, where you pay a certain amount, like in the UK, right? Very few countries have that. You pay a tax on the total estate, regardless of who is going to get the estate, or which, because it can be your dog. The tax is... the amount of the taxation is going to be independent of the number of receivers. In most countries, France, Belgium, I mean, we have inheritance tax where the tax first has to be given in priority to children if there are any children, equal sharing, almost equal sharing, so total. And so the tax is going to be, the amount of the taxation is going to be, to depend on the number of heirs. You can see that behind those two type of taxation, you have different views of the family. One of the problems with the taxation is human capital transmission. It's very difficult you don't tax, or you can tax through the income tax, but you cannot tax the transmission of human capital. There is also the idea that it could be linked to the income, but to come back, I mean, that's going to be my concluding. Mr. Chairman, you can be reassured I'm stopping here. because I'm hoping that there will be a discussion. But my view is that, yesterday I was talking with Emmanuel Saiz, who knows the field a bit, and we were talking about the way, I mean, those issues are handled in many countries. I am an outsider. I can see the way, I mean, the French have been handling le bouclier fiscal and the estate tax and the annual wealth tax. It escapes any kind of rational reasoning. I mean, it's getting purely political, and it's sad for democracy, I think, because we need a little bit of rationality in those very important issues and not pure demagogy. But that's a viewpoint. Thank you.